Imagine a country where interest rates are so low that banks almost pay you to borrow money. Japan has lived this reality for decades. In a global economy where central banks constantly adjust rates to manage growth and inflation, Japan has taken an extreme approach. Its goal: stimulate economic activity while combating deflationary pressures. From consumer spending to corporate investment, interest rates influence almost every aspect of daily life. And yet, the Bank of Japan has managed this delicate balance in ways that often puzzle economists abroad. Understanding how Japan uses interest rates to drive growth provides insights into one of the world's most unique economic experiments. Interest rates, at their core, determine the cost of borrowing. When rates are low, borrowing becomes cheaper, encouraging businesses to invest in equipment, technology, and expansion. Consumers are more likely to finance homes, cars, and other purchases. Japan's strategy has relied on keeping rates at or near zero to encourage these behaviors, countering decades of stagnant growth and deflation. But the approach isn't without risk. Too low rates can discourage saving and reduce bank profitability. Yet, Japan has embraced this strategy because it believes that boosting spending today will ultimately generate broader economic growth tomorrow. It's a calculated gamble on behavior, psychology, and market dynamics. Historically, Japan's economy faced a massive bubble in the late 1980s, followed by a lost decade of stagnation in the 1990s. Inflation remained minimal, and consumer confidence wavered. Traditional monetary policies, including moderate rate cuts, proved insufficient to ignite the economy. That's when the Bank of Japan began experimenting with unconventional strategies. Zero interest rates, quantitative easing, and forward guidance became tools designed to reshape expectations. By signaling that borrowing would remain cheap and steady, policymakers aimed to make investment and spending decisions predictable. The idea was simple: reduce uncertainty and the economy would respond. The effect of these policies on businesses has been profound. Large corporations can finance expansion at historically low costs. Small and medium enterprises, often more sensitive to financing costs, gain a similar advantage. The hope is that lower rates translate into higher capital expenditure, job creation, and innovation. Yet Japan also faces structural challenges, including an aging population and shrinking workforce. These factors can dampen the effectiveness of low rates, highlighting that monetary policy alone cannot drive growth. Instead, interest rates must work in tandem with labor market reforms, fiscal policy, and social programs to maximize impact. For consumers, low interest rates mean cheaper loans for homes, cars, and education. Mortgage rates in Japan have remained near zero for years, encouraging home ownership and boosting construction activity. At the same time, consumers are nudged to spend rather than hoard cash, which is particularly important in a society historically cautious about debt. Central banks aim to create a balance, enough incentive to borrow and invest without triggering reckless financial behavior. Japan's experience shows how subtle psychology and financial incentives intersect as households and businesses adjust to a landscape where money is cheap but future economic growth is uncertain. Wage growth plays a critical role in Japan's economic puzzle. Even with ultra-low rates, spending remains muted if incomes stagnate. That's why the Bank of Japan and policymakers pay close attention to labor dynamics. Encouraging higher wages ensures that the benefits of cheap credit translate into actual consumption. Companies face subtle pressure to pass productivity gains to employees, creating a cycle of spending and investment. This interplay between monetary policy and labor market dynamics demonstrates that interest rates are not just numbers. They are part of a broader ecosystem influencing daily life, corporate behavior, and national economic health. Japan's approach has also reshaped its financial markets. Ultra-low interest rates have pushed investors towards stocks, real estate, and other assets in search of returns. This portfolio rebalancing effect has increased capital inflows into productive sectors, further supporting growth. The strategy also helps maintain currency stability. A weaker yen can boost exports by making Japanese goods cheaper abroad, while a stable interest rate environment reassures both domestic and international investors. In essence, Japan uses interest rates as both a domestic and global lever, influencing behavior across multiple levels of its economy simultaneously. One of the most discussed innovations in Japan's monetary policy toolkit is quantitative easing. By purchasing government bonds and other assets, the central bank injects liquidity into the financial system. Combined with near-zero interest rates, this creates an environment where capital is abundant and accessible. The goal is to reduce the cost of borrowing further and stimulate lending, spending, and investment. Quantitative easing also signals commitment. The Bank of Japan intends to maintain support until inflation and growth targets are met. This communication component is crucial because expectations about the future drive much of economic behavior today. Critics argue that prolonged low rates can create distortions. Banks may earn less profit, savers may feel penalized, and asset bubbles could emerge. Japan has carefully managed these risks, implementing policies gradually and monitoring market reactions. The strategy is deliberate, experimental, and long-term. Unlike some countries that rely on sharp, reactive rate changes, Japan emphasizes stability and predictability. The goal is not to produce short-term excitement, but to create sustainable conditions where investment, consumption, and innovation can flourish. This careful orchestration underscores the complexity of using monetary policy to shape an entire economy. Global investors watch Japan closely because its experience offers lessons for other economies facing low inflation and slow growth. Interest rate policies in Europe and the US have drawn inspiration from Japan's experiments. The country has effectively become a laboratory, testing how low rates, forward guidance, and quantitative easing interact with social and economic structures. By observing Japan, other nations learn how interest rates influence wages, spending habits, business expansion, and financial stability. The insights gained extend far beyond Tokyo, shaping global economic strategy. Japan's unique demographic situation adds another layer of complexity. With an aging population, fewer workers support more retirees, which affects consumption patterns and savings rates. Interest rates alone cannot solve these structural challenges, but they can mitigate some effects. By making borrowing cheap, the government and central bank encourage continued participation in the economy. Housing markets, education investment, and entrepreneurial activity are all influenced by these incentives. Low rates act as a counterweight to demographic pressures, highlighting how monetary policy can be tailored to national circumstances. The Bank of Japan's approach demonstrates the importance of coordination between monetary policy and broader economic strategy. Interest rates are not a standalone tool. They interact with fiscal measures, labor policies, and structural reforms. By considering these factors holistically, policymakers aim to create an ecosystem that fosters growth, stability, and innovation. Japan's decades-long experiment illustrates the power and limitations of monetary policy. It is not a magic wand, but a carefully calibrated instrument that, when combined with complementary strategies, can shape the economic destiny of a nation. Ultimately, Japan's use of interest rates to stimulate growth offers lessons for the world. It shows how careful, deliberate policies can influence behavior, investment, and consumption over time. It highlights the connection between monetary policy, wages, demographics, and culture. Most importantly, it demonstrates that central banks can do more than react. They can guide, encourage, and shape the path of an entire economy. As other countries face similar challenges, Japan's experience will remain a reference point, showing how interest rates can be a powerful lever for sustainable, long-term economic growth.